Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Adam Whitlam, part of our Canadian dollar institutional sales team. This episode is titled, Won't Get Fooled Again. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Adam, welcome back to the show. Appreciate you coming on as a semi-regular guest.
Thanks, Benny. Yeah, it's been a long time. I kind of felt like I was off the hook, or maybe something I said in one of the previous podcasts was offensive to the audience and I got the boot, but it's nice to be back.
Just offensive to me, but that's okay. We're okay with that here.
That's regular.
Lots going on as always, it seems. It almost feels like I should be doing this more often, but last week we had the bank. I happened to be in Tokyo, and so there was no podcast, and I didn't get to cover the bank, which I guess was kind of a break for me, so good for me. But it's been very eventful, ongoing headlines from the U.S. pretty much every day, almost.
Every day there's a tweet.
Something flip-flopping, one or the other, on tariffs, on just policy in general, on Powell, the list does go on. And then in Canada, last week we had the bank, as I mentioned, and we're in the middle of a federal election. So plenty to talk about. Why don't we start with the Bank of Canada, since that's kind of in the rearview mirror now, and I don't think it should take that long. They were, I think, as expected. They were largely as what I had written up, I think. I did most of my reading on it on the plane, so for whatever that's worth, but it seemed like they were largely par for the course, pausing, waiting on more information. They reiterated they want to be reactive, not proactive. So that means when the data weakens, if inflation allows, they will cut more. The question is, I guess, what triggers that at the end of the day? And how weak does it have to be? So I think the latter question is the hard one, because they gave us a scenario. They gave us multiple scenarios, and which one of those leads to more cuts? The worst one probably does. Does the mild one? I'm not entirely sure. It seemed pretty mild, so maybe not, but we'll have to see how the data kind of evolve, I think, over the next number of weeks, and that will determine whether they cut in June or not. Right now, our base case is a cut in June. You don't really like this base case.
No, don't like it at all.
BMO's official call is 3 more cuts. That's fine. It could be 2. It could be 1. That really does depend on the data.
It could be 0.
It could be 0. So why don't you lay out your scenario, and then I'll pick it apart like the terrible human being that I am.
Sure. Perfect. Okay. Well, so like you said, you were away when the Bank of Canada got going. We had a pretty strong bid to our market leading up into the Bank of Canada. We had the April gap kind of sitting in and around 50-50 for a cut, which in my opinion, and I made it clear to everyone I talked to, was way overpriced and way overblown. I thought Whitlam had been super clear up to that point, discussing that he had already made some insurance cuts and that he didn't want to fight a trade war using overnight, monetary policy rates. And, I guess the argument for a cut was being made with regards to the Business Outlook survey. But is anyone really surprised that the Business Outlook survey was going to come in weaker? This is a group of people that are forecasting what their intentions are going to be in the midst of a trade war, which once again, for the, I'm not sure how many times, 3rd, 4th, 5th time, have been kicked down the road another 90 days, which has been just typical of what we've seen from the U.S. administration. Even now, as of Monday, we had a war on the chair of the Federal Reserve. And, now it's Wednesday and everything is good there. He's in place. He's going to be there forever. He's great. And again, with China, where it was, we're going to have massive tariffs on China, and all of a sudden, oh, you know what? Maybe we should back that off to half of what it was. So, we're in an environment where there's a lot of extremism. And if you're looking at, say, the Business Outlook survey, it becomes very hard to have hiring intentions down the road that are positive. So it shouldn't have really been that surprising that was negative. But the market seemed to lean on this narrative that, well, that's pretty negative. The Bank of Canada needs to be proactive and get ahead of it. But I think that Tiff had been really clear that inflation hadn't come down. We heard Nothing but price stability, price stability. Our mandate is price stability from him, both at this statement and at the previous statement. We've heard the same thing out of the Fed. So when core inflation, which did come down by a tenth, but when core inflation is still running at 2.7, 2.8%, I don't really think you're in an environment where cutting rates is really on the table. And so, in addition to that, we talk about the scenarios, and I'm glad you brought that up. So when I was reading through the two scenarios, what stood out was in a really bad tariff war, we're going to have terrible stagflation. Oh, and by the way, he mentioned price stability about 5 times. So that's an environment where it becomes, again, challenging for the Bank of Canada to go out there and start cutting rates. Because if you have inflation running at 3.5%, 4%, cutting rates probably is going to be something you're reluctant to do. You're going to lean more on the fiscal side. And then in the other scenario, which was much more calm, tariffs were to come off, we did still see inflation come up a little bit, but then come down. And then it was really a matter of how much we would see growth and demand decline. So in that environment, things seem a lot more stable. And if they're a lot more stable and inflation continues to trend down toward 2%, you could make an argument for another cut. But I don't think that's something that's happening in June. And, I think that's something that you need to at least look toward the end of the 90-day window that we now have with the U.S. administration before you even contemplate that. And then again, on top of that, the press conference, it was unbelievable to see how many people in that press conference were asking questions like, would you cut 50 basis points if you had to? And the bias, we all know the bias. We have a ton of people with mortgage resets happening in the next 2 years, and it was as obvious as it could possibly be in that press conference.
Do you think the reporters have the mortgages? Is that?
I think everybody's got a mortgage, everybody. And so everybody's got a vested interest in lower rates. But I think we need to prepare ourselves that, there is a world where, 275 or maybe 250 is the actual terminal rate.
I'm not going to entirely disagree, just mostly. The way, at least from my perspective, the way the bank thinks about inflation is primarily through its output gap framework. And that's how it looks at long-term inflation pressures. So the bad tariff scenario includes a lot of counter tariffs, and that helps push up prices a lot. I don't really see that happening. Like even if tariffs, I feel like right now our best worst case, whatever you want to call it, because I kind of think there's really only one case, is largely status quo. Like that's almost the worst case, is that things stay where they are, and Canada continues to have 25% on non-USMCA goods, 10% on non-USMCA oil and minerals, which is like zero, which is effectively zero. And the real issue for Canada is the tariff on assembled autos, the risk of tariffs on parts, and then the tariffs on steel, aluminum. Lumber's probably coming. They already did some, I think they were countervailing duties on lumber already. There's already other tariffs on there anyways. Copper, other metals and minerals are I think, the bigger risk for Canada. But that doesn't trickle through to inflation pressure, I don't think. And even if it does, it's more short-term in nature than it is long-term in nature. And so what it does is it maybe gives the bank a reason to pause for a little bit longer. But the economic weakness that those tariffs and the uncertainty create drives more disinflationary pressure over the medium term. And because I think the U.S. does not end up in good shape on the back of all this, maybe they go into recession, maybe they don't, but either way, growth slows down. That is a negative for Canadian exports over and above the tariffs. And so you have kind of another disinflationary impulse coming through the economy. And so short term, yes, there might be some inflation, maybe, and even then I'm not so sure. But medium term, kind of 12 plus months out, you're looking at a lot more disinflationary pressure, and they set policy for that term, not for the next 6 months. Where I would be wrong is if inflation does pick up and they get very worried about inflation expectations. That would be an issue. That is certainly possible. I will not rule that out at all. But it's not as simple as the scenarios they laid out, I think, because there's a lot of middle ground in there, and the end result will be different from what anybody thinks probably, and different surely from what I think. So if we get weaker data over the next 6 weeks, and we are going to get a soft GDP number for February next week, I think I'm a tick below the flash, so a small negative, minus 0.1. I'm not finalized yet, but that should be where I am. And then for March, I think it should also be pretty weak. We don't have any data on March yet, so it's kind of hard to know, but it should be on the soft side. So you get 2 softer GDP numbers, and then we'll see what the jobs numbers do. That part, I would guess, would also probably be soft. You're going to start to pick up some layoffs in some of those sectors that are under pressure. And then the other major data release is CPI, which is going to be super weak because you have the carbon tax coming off and you have oil prices falling massively. Gas prices are down about 10%, even though that includes the carbon tax and oil prices falling. But it's a chunky number. And so if you get the weaker data, inflation's not going to keep them from cutting next month. Like there's really nothing holding them back unless the data hold in, which is kind of hard for me to see. So that's why June, I think, is reasonable. We're like 15-ish basis points price. I wouldn't be gung-ho to receive that here, but I think it's fine. I wouldn't be paying it either. What I prefer is when terminal gets maybe a little higher from here, I think we're around 230 today, give or take. If that backs up to 235 or 240, I think you want to receive that. And if it gets to 240 plus, I think you want to receive that with both hands. Like you'd probably even agree.
Yeah,
that's probably where the risks are by the end of this year. Looking into 2026, that's a very different story, doubly with fiscal policy coming, depending on who wins the election. But then there's risk of some hikes in 2026, which seems to be where your bias is. Oddly, Adam has a mortgage. He wants higher rates. This is very confusing for me. I was not expecting this. I, on the other hand, don't, thank God, since I bought my house long enough ago that it wasn't $1 billion. And so, yes, we're different places. We're not arguing our PAs here, which is good, I guess.
Unbiased opinions.
Unbiased. There you go, folks. So I guess that we lay out maybe both sides for the bank there. You're a little more hawkish, and I'd say I'm more middle than I am super dovish. Like, I think there's still plenty of folks out there that think Canada's doomed and we're going to cut down to some super low number, but I don't think that's the case anymore. And the other point I think, and I didn't stress this enough, is the fiscal side is a huge wild card. And that is one where that might make the bank pause and not cut any further. That is certainly possible. Like if the Liberals win, I guess you have an extra 0.5% to 1% in net stimulus for this year, depending on how you want to calculate it. That is some offset.
that kind of seems like what Whitlam and the bank wants. They want a fiscal response to a trade war. They want to be able to manage price stability by using overnight rates. So I think in that event, with the Liberal platform has an additional $136 billion worth
over 4 years. That's a long
time.
time.
Worth of measures over 4 years, and the Conservative platform has less than that. I think it's $75 billion over 4 years. But I mean, that's a step in the right direction. If you're Whitlam, you don't have to lean on policy rate.
I'm not going to lean too heavily on those platforms. They're, let's say, each one is flawed in their own special way. The one flaw that they share, though, is they're using baseline growth from the Parliamentary Budget Office of 1.7% for this year, which is not happening. I mean, I guess it's possible if I'm dead wrong on the impact of all this uncertainty in the tariffs. Maybe February and March and probably April won't be that bad, but I have a lot of trouble seeing that. We are a full percentage point below that for this year, which is probably on the conservative side, admittedly. But even if its growth is 1%, let's say, that means you're starting with one, a deeper hole, which is almost certain, I think, in the first place. And two, the revenues will not be nearly as strong. So both the Liberals and the Conservatives probably are actually have wider deficits than what's in their platform for this year and for next year. And then that should filter throughout out years as well. So don't lean too heavily on those platforms, folks.
But I mean, the Liberal platform, which has more fiscal spending in there, I think that's a 2% of GDP deficit.
Yes. So it's about 1% larger than it was. The problem is they're including $20 billion in tariff revenue, which technically comes from us. So that's kind of like a tax. And so on a net basis, you have to exclude that, which then limits the amount of stimulus in year one. So that's why it's kind of like saying 0.5% to 1%. It's more like 0.5 than 1%, but I'm just going to, it's a bit wider there.
I mean, even if we push that up to 3.5% of GDP, we're still a much cleaner, dirty shirt than our neighbors to the south.
Well, there's that. I mean, is that the comparison you want to make? And the answer is probably not the best one. I mean, for the first time in my life, I've advocated openly for looser fiscal policy. And I'd love to see more than what's been promised already on military spending, for example. And I'd love to see more on tax reform. And if that costs some money, that should be okay to drive Canadian competitiveness. I think my biggest beef with everything that's going on is that neither party is really addressing the competitiveness problem. There's some red tape cutting, great, but I don't see how plowing more money, more Canadian resources into housing, which is the bane of the Canadian economy's existence, quite frankly, or keeping the federal government its current size and not actively trying to shrink it. I mean, neither party is looking at downsizing the federal workforce after it's grown substantially over the past 10 years. Those are not high productivity sectors. And so that, I guess...
Sounds like you're running for Doge.
I mean, that sap on productivity is only going to get worse. I don't get it personally. It doesn't make a lot of sense to me. And so this could have been a big moment for Canada, and no one's really, at least in my opinion, really stepped up to the plate in a way that is satisfactory for me, unfortunately. But maybe I'm just asking for too much.
I think, from my perspective, I know this is off the beaten path of fixed income, so we'll go back to that in a moment. But I think there's a big opportunity for Canada in the education sector. It's an area that it's become very apparent with what's going on in U.S. discourse that there is some discontent amongst post-secondary institutions, well-regarded post-secondary institutions down there. And it seems like a great opportunity for Canada, Liberals, Conservatives, if you're listening, to potentially put in place some incentives to bring up some of the world's brightest and best to our institutions here and become an education powerhouse of the world.
Prime Minister Carney mentioned that on one of the podcasts he was on just this week. So clearly that's the way that you lean as well.
Oh, dear.
Things aren't always cut and dry, folks, despite what we'd like to think. So I guess that's enough politics for one day. I mean, I guess the one thing we didn't really touch on is the market side of what's gone on and how the politics, I guess, might influence things, and that even if we do get more stimulus, more debt from Canada, you mentioned 3.5%, like even if it were 4% of GDP or deficit, we still would look much better than the US, and Canada on a relative basis would look better than most countries. And I don't think that would prompt global investors to shy away at all from Canada. If anything, we're faced with a prime opportunity to draw in more international funds. The US, my only real takeaway from the past month is from like a financial market perspective, because everything is just so uncertain, is that the US dollar has not performed as you thought it would. And that's been consistent for this month all the time. I mean, that's the one thing that's been consistent. And in days where there is risk off, the dollar is weaker. And the days where there was risk on, the dollar is kind of flattish, maybe a touch stronger. And that is the opposite of what you'd expect. And like, that is not normal, folks. And it just tells you that there's a little bit less appetite, I think, to be buying dollars when there is fear out there, which is not a good sign for the global reserve currency and for treasuries generally. So I don't think people are going to be selling dollars and treasuries en masse. That's not happening. The treasury market is the deepest, most liquid market in the world. There's no replacing it. You cannot take that money and put it somewhere else. There's nowhere else for it to go. That's simple. However, incremental dollars do not need to go into the U.S. And I think that's where Canada has a big opportunity. And I think you'll probably see something akin to what we got post-financial crisis and really the 10 years after that, where reserve managers were building positions in other currencies, Canadian dollars being one of them. And we went from effectively not quite a zero weight in reserves, but they didn't keep track of it because it was so small, so who cares, to 3% now. And so that might push up another percentage point or two over the next 1, 2, 3, 5, 10 years, something like that. Probably like 3 to 10 years. It's not a 1 year thing. That's good. I mean, that's positive for Canada. It's good for spread product. It's good for Canada. It's all that kind of stuff. So
on global reserves are about $12.5 trillion. So like a 1% shift in a $12.5 trillion global portfolio is a sizable amount. And, that will have major ramifications.
$100 billion is a big number for Canada.
Major ramifications to the Canadian market and interest in the Canadian market. And this has been a kind of a big topic globally. I mean, talking to our U.S. franchise as well, questions from from, global investors regarding, the US as a reserve currency. And I agree with you. You can't suddenly say, well, the US is no longer going to be a reserve currency. That's done, off to something else, because nothing else exists. There is no market that's deep enough, liquid enough. If you look at the auction stats in the US for the last 10-year and 30-year for foreign investment was actually quite high. I think the 10-year had the highest number of foreign buyers since, I want to say, 2021. So, we're still seeing lots of interest to invest in US Treasuries. However, I do think there's some aspect of, a crisis of confidence in the US dollar, which is one of the reasons we're seeing the currency underperform, and just general uncertainty. And that general uncertainty will probably encourage, currencies to float into other pairs, including Canada, including Euro. I mean, we've seen it if you look at even equity market returns. In the European stock market has outperformed Canada and the US dramatically. And so, I think you're seeing a little bit of that capital staying into some of their home countries. You're seeing a little bit more diversification. And so even at the margins, if we're talking 1%, that will put a pretty strong bid into Canada. That will keep Canada rich versus the US.
Canadian dollar is the one bigger beneficiary I see out of all this. And in a way that I probably haven't, and also it feels like forever. It's got to be 10 years, give or take, since oil collapsed in 14, 15. It's been tough sledding for the Canadian dollar pretty consistently. A one-way ride for the most part. And now I can see a world where we trade back even through 120. Wouldn't be like totally shocking if we get these kind of inflows that could come our way. So, I mean, we're not forecasting 115, but 130 by the end of this year is certainly doable.
Yep.
Especially if this pressure on the dollar continues. There's really no question on that front. And really, as we're talking more headlines that some maybe Chinese auto parts might get exempted from tariffs. Hopefully that means Canadian auto parts also get exempted. That would be a big positive for Canada. But to your point, I guess it goes back to the fact that like stuff is changing every day. They've fooled us enough times with these headlines being fake and then going the other way and then back and forth. So you want to be as patient as possible with policy, and investors are doing the same thing. So what are the investors that you're talking to doing? Are they, similar to mine, just kind of staying as close to home as possible?
Yeah, I would say conviction is low. For the most part, trading positions are in it for a few basis points here and there. It's tough to really say this is where I want to, I want to draw my line in the sand and put a lot of money to work at this specific level. There are a couple things that are maybe topical that we should probably note. So, one thing, if we're talking about Canada, investments into Canada internationally, we've seen a ton of interest in provincial bonds. I think there is a large subset of investors who are looking at Canadian provincial bonds saying, hey, when we had a COVID crisis, the government was willing to step in and guarantee these things. And on a spread basis, a 30-year Ontario trades 90, today it's 93.5 basis points above a Canada bond. That looks pretty attractive from an all-in yield perspective. Just
to interrupt, they didn't guarantee them technically. They just bought
them.
They bought a lot of the sub-10-year sector. So I just had to...
Right. That's fair. That's a fair point. They didn't guarantee it. They bought the sub-10-year sector. But there's some confidence that the federal government implicitly will step in to support this product. And so I think a lot of international investors look at this and say, oh, this looks like a pretty great product. I'm getting a lot of spread pickup for a government product above the Canada curve, and so if I swap this back to my home currency, this looks kind of attractive. So we've seen a lot of international interest to support it. To speak to that point, if you look at the performance of long provincials, say from the start of the month, they've performed better than everything, better than any other risk asset.
They're tighter because they were cheap.
Right. They were cheap. They underperformed into the rally, and they've really outperformed into some of the volatility that we've had. And we've continued to see buying. So, and that's despite the fact that provincial budgets have all come in a little weaker than expected. The issuance platform for the coming year is still looking pretty robust. They'll be tapping regularly, but we're still seeing a lot of demand flow into that. And I don't really foresee that changing. Long Canada yields, that's another one that's been kind of topical. The last time that we touched the 350s would have been kind of earlier this year. I think it was sort of January. That was a buy zone for a lot of the domestic real money. We saw a chunky amount of buying. The entire street ended up being short longs after a long episode, say a year prior, where the entire street was also short longs. I would say we're back at 350 again, and we haven't seen the same amount of outright interest come in to buy it. So I don't know if the new level is 375 where they decide, okay, now we're going to start to acquire things. But I think it is kind of topical when we say, like, it's tough for investors to have strong views here, because at 350, there aren't as many outright domestic buyers of government of Canada bonds, and the street positioning feels a little more two-way. What does that mean for the curve? That could suggest that there's room for the 10s, 30s curve in Canada to steepen from here if there isn't as much outright demand for long bonds. So we could see a drift from sort of the low 30s where we are now back up toward 40 or even 50, just given there's not as much outright interest.
I'm cringing a little bit if you can't see me on the podcast because I don't allow video, even though they want me to. June 1. That's a big caveat there. In that it's coming very soon, sooner than you think, unfortunately. And soon it will be every other day or every other minute. You'll be like, oh, June 1. Let's talk about that. And that hard to be in steepening into June 1, at least not with the long end, not 10s, 30s. After that, I'm with you. I think bigger picture, I think there is room for the curve to steepen generally, especially since I'm a little more dovish on monetary policy than you are, and probably concerned about inflation more medium term. But I think near term, it's going to be a little bit challenging. Definitely. That uncertainty vibe and that lack of conviction extended overseas. And my trip to Tokyo last week, that was the theme there as well. That investors in Japan that look at Canada see the uncertainty around tariffs and the uncertainty around the election, and they're just like, there are a lot of unknowns here. Maybe we can wait for things to clear up a little bit before we get a little bit more involved. That being said, they are still looking at Canada, and it is reasonably attractive for them right now. You look at kind of 30-year provincial bonds on a hedged basis, so hedged back to yen. They are attractive from that perspective. On an outright yield basis, unhedged, not so much, but hedged, they look pretty good. So I think there will be interest as we get some clarity there. One more reason that spreads will be supported, but it might not be for another few weeks or maybe a couple months or so till we at least have a little bit more clarity. I don't know if we'll need clarity on the election or clarity on tariffs or both, but just less uncertainty than what we currently have right now. So we'll see how that plays out. Favorite trade here?
So I'm going to keep everything really short term just because that's sort of the nature of this market. You got to be in and out of stuff very quickly. One thing, and I know that I was kind of discussing, there's a possibility of the 10s, 30s curve kind of re-steepening back toward 50 basis points. Again, that's maybe more of a longer term trade. You do have sort of June 1 to contend with. Just on the back of the move today, Canada-US, a 10s, 30s box is kind of getting back to a pretty attractive level. We're actually bouncing up against the 200 moving day average, which would suggest Canada goes flatter relative to the US. I kind of like the narrative there. I mean, we've had these bouts in the US of massive and abrupt steepening. So given that I'm surely not out of the woods, there's absolutely room for, more steepening to happen. The last time we saw US longs get close to 5%, we saw some support, but we're all the way back down at 480 now. So I think at this point, there's more of a fundamental reason in the short term to maybe buy a Canada flattener in 10s, 30s relative to the US. So that trade technically looks like kind of a nice buy.
And June 1.
So there are reasons why this is a good trade to put on in the short term. Another thing I like would be, and again, a lot of this has happened today because of the cross market move, but 2s, 5s, 10s in Canada relative to the US has cheapened up a lot. We're back to zero. Again, cross market on swap. So yeah, and that's been a level where we found good support to receive Canada. We have seen some profit taking. There were short positions in 5s. 5s in Canada, if you ever listen to Joel Prusky, are perpetually expensive, but we're actually getting to a point now on the curve where they look kind of cheap. Doesn't happen often, doesn't usually stick around for a long time. So I don't mind receiving some 5s on the curve. I think mortgage, we'll see how the mortgage season hashes out. For the first time in a long time, we actually saw some fading of 5 years from the bank treasury crowd, which is something we haven't seen very often. That would kind of indicate that there actually has been a little bit of back and forth into fixing in 5-year mortgages.
I've been looking at the data, refreshing it every day to see if it comes out. It's not the numbers for February aren't out yet, but I don't even know if it matters. It'll be March, April, if anything. So still a couple months before we get more clarity on those mortgage flows. Yeah.
So there's a little bit of that at margin, which maybe could add some softness potentially to 5s, or is maybe one of the reasons that 5s have been underperforming and why they look a little cheap here. But on a cross market basis versus the US, again, technically at zero, it's traditionally been a good place to get long Canada. So that's another tactical trade that I like here.
Okay. I don't mind those at all. for all those fixed income folks out there. Santo sent out a piece on June 1 with a few trade ideas in there. So please feel free to check that out. And if you haven't seen it, reach out to your friendly BMO salesperson like Mr. Adam Whitlam here, and they'll happily hook you up. Thanks for listening. And Adam, thanks for coming on.
Thanks for having me, Ben.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.